Welcome to my channel. My name is Tim Sutherland. Today we're going to cover items that have been changed by Fannie Mae, Freddie Mac in regards to the purchase of investment properties. Now, this news came out a while ago, and at this point I figured most people had heard about it, but I spoke with two clients at Admiral. I said the news isn't really out there to any extent, so I'm going to cover it. Any of my clients can go through this by way of explanation, or if anybody else is interested, certainly view this too. Now, back in the beginning of February, Fannie Mae and Freddie Mac put out an announcement, and essentially we're going to go over what it says here. I already covered this part in another video. And what it says, they're going to limit the acquisition of single-family mortgage loans backed by second home and investment properties. So we must limit our acquisition of single-family mortgage loans secured by either second home or investment properties to not more than 7% of the single-family mortgage loans we've acquired during the preceding 52-week period, basically a rolling year. So what does that mean? Well, Fannie Mae and Freddie Mac, they back a lot of the conventional conforming loans. So essentially, if your loan amount is started this year under about 548, previous years it was lower in most of the country, and there are various parts of the country or counties that have higher limits. There's a good chance Fannie Mae or Freddie Mac got it, especially with a second home or investment property. Whether your loan is through somebody servicing or selling it, this is more of a back-end thing, and you won't even notice if Fannie Mae or Freddie Mac buy it because they do not service loans. However, they would still own it, regardless of where you're sending your payment. So what does this part mean? It means now the lenders have got some different dynamics going on. Usually, after you close, they're going to sell the loan to Fannie and Freddie probably within a week or two after your closing. Now they may not be able to do that. So now they have to, they've got additional cost, primarily hedging costs, because suppose they've closed you at one rate, rates go up. Now they've got a limited market for this loan they're sitting on at a lower rate. So they're going to pass some of that cost along. Now each lender is going to look at it differently. It's not going to be a uniform adjustment. Fannie Mae and Freddie Mac have their own adjustments called loan level price adjustments, or LLPAs. And I did another video on those. You can always go to that, and it shows you what all those adjustments are. In this case, it's going to vary by lender by lender. You're going to try to cover the hedging. Maybe they got to sell it to somewhere else that's not Fannie Mae or Freddie Mac and may have their own pricing items. And some of the pool itself is going to be limited because generally if a loan doesn't meet Fannie Mae or Freddie Mac guidelines written sold by them, and it's a conventional loan, it's referred to as non-conforming. It just means not conforming to Fannie Mae or Freddie Mac. Now most non-conforming lenders, which many people refer to as jumbo, will have a minimum loan amount, which is above, usually $1 above the conforming loan limit. So unless some of them change and start buying these, many of those pools are not eligible direction in which to sell your second home or investment property loan. As a consequence, smaller pool could affect pricing, supply and demand dynamic. Now you want to talk to whatever lender you're working with because each one's handling this differently. Like I said, it's not a uniform thing. It's how it may impact you. And on top of which, a lot of it's back end from secondary pricing stuff. So even the person you deal with could say, oh, we're not doing anything, or we don't know. And back end just announces, oh, we're making this adjustment starting now. Yeah, because it's not something they're probably going to give a lot of notice on just due to the cost involved. Ultimately, so what does this mean? I'll go here. So here's a list of what Fannie Mae and Freddie Mac, and this particular sheet's from Fannie Mae, have bought in a way primary, second investor homes over the last few years. This is 2020, 19, 18. The next sections are what they still have on their books. So back in 2018, that was 11% of their business. Now 19 and 20, Each year it was only 8% of the business. It's not a big drop in relative to the other business with that 7% cap, but it's only relative to the overall amount of business. 2020, a lot of people refinanced, so it diluted some. 2021 could be a whole different story. How it impacts what they'll buy and what they won't buy. And again, what happens then? Lenders are sitting on it. They may or may not pass costs along to you if there are any, and each one's different. So I do suggest you talk to whoever you're working with and ask them how it'll be handled if you're looking at investment property or vacation homes. If you have any questions, leave comments below. If you like the video, hit the like button. Join my slowly growing list of followers. And thank you for viewing my video. Bye-bye.